our board, and I am a trustee at the Ela Area Public Library District in Lake Zurich, which is a suburb located about 40 miles northwest of Chicago. If you haven't done so yet, please introduce yourself in the chat. And on behalf of the ILA Trustee Forum, I'm happy to welcome you to today's workshop. The Trustee Forum Board meets 4 times a year, planning trustee training events like the March program on COVID, the April program on diversity, inclusion, and equity, and today's program. We also suggest sessions for Trustee Day at the ILA Annual Conference and select the Trustee of the Year. Today is the deadline for submitting nominations for the award, so if you had someone in mind, now is the time. And if you might be interested in joining the Trustee Forum Board or nominating a trustee for the Trustee of the Year award, just visit the Trustee Forum page on the ILA website. And you can also mention your interest in being considered for the Forum Board on your evaluation following today's program. We have a full agenda today and a record level of attendees with more than 180, perhaps 200 registrants. So let's dive in. First, we have Jamie Rachlin, the founder and president of Meristem Advisors. Meristem Advisors was founded on the principle that clients want and deserve to have deeper conversations with their municipal advisors. Prior to forming Meristem Advisors, Jamie was a public finance banker for 25 years. Jamie's proud to serve on the board of Open Lands, an Illinois not-for-profit dedicated to nature-based solutions to climate change. Welcome, Jamie.
Morning, everybody. I hope you can hear me. And if anything happens with the video where I need to turn off my video to help the streaming, let me know as we go along. But I put this presentation together as a as an overview and just general concepts for trustees, so that not so much to give you specific knowledge about any one area, although we'll dive into a couple of things, as to give you sort of a conceptual framework for thinking about finance and your responsibilities as trustees regarding the finances of your district. So let's jump in. So overview, high level. What are your roles and responsibilities as a board member? Number one, you enact the budget and the levy each year. You set the financial direction for the library. You have control over the expenditures, how money gets spent, and you should be setting clear expectations for the district's financial health. Where do you want to be in fund balances? How do you want to spend your money relative to revenue? You want to set general guidelines as to budget priorities and how you want the financial operations of the district to proceed. You know, when do you want to overspend your revenues? When do you want to underspend your revenues? That sort of thing. Establish a broad financial strategy. Where are you going financially? Monitor financial performance. That's important as the year goes on. And then most helpful is going to be if you establish specific policies, and we'll talk about all these things as we go along, but specific policies to govern your procedures, what you're going to do and how you're going to make decisions. So we'll get into all of these as we go along here. But for starters, recognize that as libraries, you are governed by specific laws. If you are a library district, it's one act, 75 ILCS 16-1/1-55. If you're a municipal library, it's a different act, 75 ILCS 5/1-16. But the important thing here is you can actually go read this law. It's not very long. And a lot of things we're talking about today and a lot of others that you'll hear people talk about and you won't know where they came from, they're outlined very specifically in the law, and it's not very long, and you can read it in a relatively short period of time, and it might be very, very illuminating for you. Now, we'll talk more about the type of library you are and how to figure out what type of library you are. You probably know if you are a municipal or district library, but if you're, if you're a municipal library, you might be part of a non-home rule governmental unit, in which case you are subject to the Local Government Debt Reform Act. And some libraries are also subject to the property tax exemption limitation law Those are the tax capped libraries, and we'll talk about how you know whether you're tax capped in a minute. But knowing whether you're tax capped is going to be a very important thing when it comes to budgeting and planning. If you are part of a municipal library that's part of a home rule unit of government, you're going to have a lot more flexibility with respect to your budgeting and planning. So you want to know, if you're a municipal library, you may know this already, am I part of a home rule municipality? Your library director is going to know the answer to that question. You can look up a list of Illinois home rule municipalities online as well. But that's an important thing for you to recognize as well, because how you're situated within the law is going to determine a lot of factors with respect to how you do your budgeting, planning, and financial controls. So we want to know, am I subject to tax caps? And then also, how's your levy calculated? This is another question when we get to the levy that you're going to want to know the answer to. Does my library, as part of a municipality, have its own levy calculation each year, separate and independent from the municipality, or does my levy get thrown into and along with the overall calculations of the municipality that I'm part of? Very important with respect to figuring out how much you're likely to be able to levy. All right, so back to those financial management responsibilities. Again, board, just remember, as a board member, you're responsible for those high level types of activities, right? Overall financial controls, our policies in place to make sure that there's no fraud. Do we have proper contracts? Are we tracking things according to our policy? The director gets into the nitty gritty of the daily execution of those policies. Okay, so you're high level. Who has authority to spend? Who kind of gets credit cards? Are you doing direct deposit, control over check signing, things like that? The director implements. So you're not getting into those day-to-day types of aspects of running the actual library. You're just setting those higher level policies. Okay, so let's talk briefly about this concept of tax caps, because that's going to be very, very important. And I'll just make a note here that if anyone has a comment or a question, I assume we're monitoring the chat. Please, if there's something that's clear, somebody's not understanding something, please feel free to interrupt with a question that you're seeing, because I can't see the chat, please. Okay, so are you subject to tax caps? As I said, tax caps are, there's a couple ways your ability to levy money from one year to the next is limited. And whether you're subject to tax caps or not, there are limits, but one very important limitation on your ability to levy is whether you're subject to tax caps. So who's subject to tax caps? Well, property tax caps came into effect in the 1990s for Cook County and the collar counties. So if you, with one exception that we'll talk about, if you are in Cook County or the collar counties and you're a district library, you're certainly tax capped. If you're part of a municipality, you may be tax capped unless you're part of a home rule municipality, we talked about just earlier. Downstate, outside of the collar counties, tax caps are voted in by referendum. So if you're in a county that has voted for tax caps, chances are you're a tax capped entity. If you're in one of those fortunate counties where you're not in the collar counties and tax caps haven't been voted into your county, then you're not capped. And it's a different set of limitations that you're going to be subject to when it comes to setting your levy. And we're going to talk a lot more about the levy shortly. And you'll see why this is so important. Okay, so that's just general overview, board roles and responsibilities when it comes to financing. Remember, your big picture, the administration is the details. But let's talk about budgeting, because that's one of those big picture types of responsibilities, right? The budget, and another slide on this in a second, but the budget is basically your annual statement of revenues and expenditures, making sure that over time you're going to be able to maintain a healthy cash balance. I like to see my library districts maintain at a minimum 3 to 6 months of cash expenditures at the low point. Okay, so if you're looking at cash balances, and that's an important distinction that we're going to make later on, look at your cash at the low point in your budget cycle. I'd like to see my healthy libraries have 3 to 6 months of expenditures on hand. In your budget, you're going to estimate the revenues and the expenditures, what's coming in and what you're going to spend over the course of the year, making sure that you've identified all those revenues that you are entitled to, your per capita grant, your personal property replacement taxes. And then once you know all your revenues, making sure that the expenditures are appropriate so that you're staying within that financial health sort of range where you're maintaining your cash balances. You also want to make sure that as you're doing this, that controls are in place that prevent the misuse of funds. So are you reviewing the expenditures each month, that sort of thing, and that you're following the statutory requirements for passing and amending the budget. We'll go through what those are, but there's a very specific time of year when by which you're supposed to do your budget each year, and you want to make sure you're following that calendar. Again, your director is going to know a lot of this stuff, so you're going to want to make sure that you're simply communicating with the director about when these things have to be done, but passing the budget is one of your responsibilities each year. Also good management, board management is having policies in place that sort of, so you're not continuously second guessing a decision, right? If you have policies in place, they're going to help you decide. We just refer to the policy as to whether you can do something or not. And the key financial policies that you want to have are a fund balance and balanced budget policy, right? That's that fund balance. How much money I said I like for my clients to have 3 to 6 months of cash. Maybe your library sees it differently. Maybe you want more than 6 months or 12 months. Okay, so a policy is going to give you that specific statement of financial direction as to where you want to be. So every year you don't come back and say, well, how much cash balance do we want to have this year, right? You've now got a policy. An investment policy is a second policy that's very important. Most districts will have them, but have you looked at it is the real question. How are you investing your funds? If you have idle cash laying around, how long are you going to invest that out for? And in what types of instruments and in what types of banks? That's your investment policy, and you should refer to it to make sure that you're following it. You may have a special reserve policy. Suppose you have some extra money and some capital needs coming along down the road that you're going to have to save up money for, right? You would want to set up a special reserve and have a policy for how you fund that special reserve and how you draw money down from that special reserve when those capital improvements come along and you need to pay for them. And that way, you don't have an unexpected expenditure or an expenditure that you've simply put off for years and years and years and suddenly face and you can't afford it. And then the last thing, less frequent for a library district or a library would be a debt policy. If you're borrowing frequently, you might want to have some policies and guidelines about when you're going to borrow, how much you're going to borrow, how long you're going to borrow for, that sort of thing, just to give you a guideline there as to when it's appropriate for you to borrow. So those are the 4 really financial policies that I would want you to have in place, and you can go back to your districts when we're done and find out, do you in fact have these policies in place? What do they say? And if not, you can talk about whether you should in fact have them. One very important note here is when you look at your cash, and I apologize for the smallness of the numbers here, there's not much we can do about that. Monitoring cash through the year is important, especially if we're looking at that concept of 3 to 6 months of cash at all times. Because if you'll note, most libraries, or well, in Illinois, almost all libraries are going to get their cash in two big chunks. Generally, it's going to be in June. In Cook County, it's earlier, but let's talk outside of Cook County. It's going to be in June, and then sometimes sort of September. And you can see if we look at the revenue for this sort of pretend library, here's some big cash that comes in June, and some big cash comes in September. But your expenditures are even across the year. You have pretty much the same expenditures every month. And as a result, your ending cash balances, if you go over here to the last column, are going to vary through the year. And let's start with June here, so we won't give it away, although you can see the red. Let's say you finish your year, your fiscal year is June 30th, and you finish your year with $520,000, and you think you're doing pretty well. And then you're spending $200,000 a month, and then you get more money in September, and you're up to $1 million, and you're feeling really good. But this spending is going to keep on going, $200,000 per year and per month. And because of that timing of cash, this particular district actually runs out of cash by April while they're waiting for their June tax revenue to come in. And so this is why you have to really go back and find out when's my lowest. And I think this is a good question. Go back and ask your director. When is the month that we have the lowest amount of cash on hand right before we get taxes? And how much is that? And is that enough of a cushion for us if in a year we have a surprise expenditure, or if in a year, like we've had in the last couple of last year to 2 years, delays in revenue due to COVID, can we get through that period? And if not, you need to start thinking about setting fund balance and cash balance policies that are higher so that you're not at risk of this type of thing happening. Okay, so we've already kind of talked about the budget, but just to make it clear, the budget itself is a target for your revenues, expenditures, and cash balances. It summarizes all of this stuff for the particular year that's coming up. And basically it's what's our beginning cash balance, what revenues do we expect, what expenditures do we see going out, and what's our ending cash balance. And obviously, if your revenues are more than your expenditures, you're going to be improving your financial health over time. If your expenditures are greater than your revenues, right, you're going to be eroding your cash balances over time. And so you can't keep spending more than you've got year after year. It might be okay, and it might be explainable in one given year, but you can't keep doing that over time and expect the library to remain financially healthy. So this is your budget, and this is working with the director. The director is going to come to you with that expectation for revenues and expenditures. You're going to look at it. You're going to decide, is everything about those expenditures, are we prioritizing the things that we need to? Are we taking care of all the library's needs, not just with respect to materials and personnel, but with respect to capital and operations and maintenance needs? And you're going to go through those in some level of detail and establish your priorities for the coming year. Now that's the current, sorry, one more thing before we get to the next slide here. Little different how you do the budget adoption for municipal libraries versus district libraries. Remember, as a municipal library, you're simply a component unit of the municipality. And so you're going to adopt your budget, and the budget's going to go over to the municipality for inclusion in their overall budget and appropriation. You'll have a budget hearing. And then when you do your levy, which establishes the property tax portion of your budget, you're going to send that over to the municipality too, and they're going to incorporate it into their overall levy. If you're a district library, you're on your own. you're going to run your own budget hearing. You're going to adopt specifically your own budget and appropriation and ordinance, and then you're going to do your own tax levy in the fall, late in the year, and file that with the county clerk, whereas over on the municipal side, the municipality does that for you. So that's so this really budget, right? But I want to distinguish, because there's a difference between a budget and a forecast, and it's important. A budget is really what's happening to you the current year, and it's really just a look at what are we going to do this year, what's coming up. But and that's very useful. First of all, you have to do it by law, right? But second of all, it tells you exactly, and lets you tell your staff over the coming year exactly how you're going to spend your money. And that's something, it's going to be a planning tool. I didn't say this, but you want to watch that budget over the course of the year and see how your actual spending compares to the budget. So the budget's very useful for telling you what's going on current year. But it's also important to have some kind of forecast. You want to look out past the current year. And a lot of libraries don't do this. Some do, and it's great practice. You want to know what's coming at you. So a forecast looking ahead tells you directionally, not just for the current year, but for the future where you're going. So here's just a sample 5-year forecast, right? And here's a library, if this is another fictional library, that if they looked at just 2021, let's say, their budget, they might say, hey, we look pretty good. Okay, we've got our property taxes coming in, we've got our personnel, our materials, our operations. We're generating a little surplus here of $19,000, if you can read that. Our balance at the end of the year is 35%, which is, more than 3, less than 6, but it's in that range of where we want to be financially healthy. But when they take the time, to look forward into 22, 23, 24, based on their current trends and based on their current needs, they would see, which they wouldn't see if they only did that budget, that coming down the pike, they're going to start running negative, that their expenditures are going to start exceeding revenues, maybe starting 2023. And that's going to erode their cash balances down to 25%, getting down to 20%, getting down to that range that's actually a little concerning with respect to maintaining good, appropriate cash balances. And so the forecast helps you see that. And then you would go back and say, hey, that's not sustainable. What do we want to do? What should be our strategic priorities? What do we need to change here so that we stay within our stated fund balance policy, so that we're doing at the same time what we need to take care of the library? So the budget's good for the current year. It's important. It keeps you balanced, but looking ahead might tell you something about what's coming down the pike, and it might force you to start thinking about different scenarios as contingencies, or to plan for things that are coming down the pike. And just as an aside, one thing that I see very often is that people put off capital expenditures. They say, well, we don't have to do it this year, but you're going to have to do them eventually. And if you're not planning for those, if you're not setting aside funds, that can be a problem down the line for you. And so the forecast sort of forces you to deal with the fact that those things aren't going to go away forever. All right. So Cindy, do we have any comments in the chat or questions in the chat? Anything that people want to?
There is a question that just came up a couple minutes ago, which I think is perfect for right now. It's a 2-part question. Should you worry about having too much excess each year? And is there a way to save for a major future expenditure?
Yeah, so absolutely. Couple of things. So the rule of thumb, generally speaking, and I'm not giving legal advice here, but the rule of thumb is if your outstanding fund balance plus or your fund balance plus any outstanding levy is more than twice your annual expenditures for the fund for which those, monies are held, then you can get a tax protest. Okay, so, if your IMRF, I see this a lot, an IMRF or a FICA fund starts building up a lot of excess money. Sometimes it happens in the general fund as well. Then yeah, you're subject to a tax protest and someone saying, the library has too much money, my taxes should be reduced accordingly. As a library, you're a very small part of the overall tax bill, so I don't think that happens too much for a library unless someone's protesting their taxes, more broadly. So you do want to, but nevertheless, you want to avoid hoarding money in a specific fund. And what you can do with excess money from the general fund, not so much from your restricted funds, but we talk about that later too, is you can set up a special reserve, right, to prepare for those capital costs that are coming up down the road. And you need to have a plan for those expenditures. So you need to have sort of a capital plan that says we need a new elevator, we need to replace carpets, we need a new facade, we need to fix our roof, and these things are going to happen in 24 and 26 and 31 and 33, and project that out. And then you can set up your special reserve and move money into that special reserve specifically to pay for the cost of that plan. And in a special reserve, it's my understanding, a taxpayer can't object to it because you've identified and earmarked that money for a specific purpose. So that's the best way to handle that exact situation that you were asking about.
We have a few more questions that came in. The first one is, could you explain the difference between accrual basis and the modified cash basis, plus their pros and cons?
Well, I'm going to defer to the accountants for that. And so sorry, no, I can't. I'll leave it for that. Here's what I would say about that. Those accounting concepts are important for people who look at this stuff from that point of view, as to what your resources are and timing of resources and funds that you're going to get versus funds that you have. From your standpoint as a library, as a trustee, or I should say from my standpoint, okay, because I don't want to say these other things aren't important. It comes back to cash, because that's what you care about. And these cycles and these levy cycles, they're all conflicting. And so it all just gets measured differently, and different libraries measure this stuff differently as to when it all comes down to revenue recognition and expenditure recognition and things like that. But what you want to know fundamentally at the end of the day is that you have enough cash to operate. So my view of the world is let the accountants worry about the whole modified accrual, full accrual, gap stuff. As long as you're managing so that you always have cash to operate, sufficient cash to operate, to me, that should be the first question. And then the second question is, what are we doing from an accrual basis? When are we recognizing revenue and all that stuff? And really, you should talk to your accountant to talk that through. And by the way, you can't use cash accounting anymore, I don't believe. You have to go to one of these accrual-based accounting systems. So sorry to be vague on that, but that's my perspective.
Okay, we have two more questions. The first is, how do you get your forecast numbers?
So, okay, so that's different ways and different approaches. One is certain things like materials. You can say, hey, we want to keep up with inflation. We'll just do those with inflation. Same thing with some of your operating numbers. How much is it going to cost to maintain your building? Well, as a basic sort of approach, inflation is going to be pretty good. But you also have to go in a little bit more detail, right? And say, what do we know is coming down the pike? What do we know that isn't inflationary going to have to replace carpeting, say, or furniture, or we want to implement a specific program. And so you'll sit down with the director, or the director will sit down and present to you their plan for these other expenditures that aren't necessarily inflationary. We're going to talk about personnel in a minute, which you want to actually model out, probably because of what's going on with minimum wage. So it's a combination of things. You have to sit there and go line by line and say, what's just simple inflation? What's expectations replacing technology that we know we're going to do, and sort of map those out. And revenues are fairly predictable because it's all property taxes, you can do there. But that's how you do it. And then when you project those things out, that's when you're going to start looking at what's my income look like, and do I have to go back and make adjustments? And so it's a little bit of an iterative process.
All right, one more question.
That answers the question.
Can you explain how much is too much in a fund balance? If I understand correctly, any accumulated money in fund balances can only be used for that particular fund. How do you do that when I have been told to never ask for less in a fund? I'm sorry. How do you do that when I have been told to never ask for less in a fund as each year goes in a levy?
Yeah, so your aggregate levy is what's going to be, we'll talk about this. There's endless strategies here for the levy, and we're going to talk about the levy in a minute. There's, gosh, it's a tough one to answer in 2 seconds, but too much money is what I said before. It's when the fund balance plus the uncollected levy exceeds twice your annual expenditures. There's a lot of misunderstanding on that exact topic, and what you've been told may or may not be correct, or it may have been misconstrued. There may be certain times when you have to over levy, and you just remember the penalty is a tax objection, and that's from whoever objects. So the downside's sort of limited. There may be times, in order to collect as much money as you can, you're going to over levy in certain funds. It's so situational. And without going on too long about this, it really comes down to the specifics. And I can think of lots of times when you're going to accumulate too much money in a fund. And then the goal will be over time to under levy in that fund and over levy or levy more in your general funds to draw those fund balances out. It's really hard to say without knowing the specifics to give you a concrete answer on that one. It's just too situational. We'd have to look at your particular situation. Sorry, can't be more helpful on that one. All right.
That's all we have right now.
Okay, let's keep going. Okay, let's talk briefly about borrowing. Sometimes, you don't have enough cash to do a project that you want to do, but you really want to do it. And so people want to look at borrowing. And there's essentially, without going to referendum, you can always go to referendum, right? And vote a bond issue for your project. But if you don't go to referendum, you'll have to pay for that project from within your current operating budget. And you have 2 options. One is a debt certificate, very straightforward. Basically, we're going to borrow money and promise to pay it back. You can do that over 20 years, and just debt service gets paid out of your operating budget. Investors will look at your credit and decide whether what the likelihood is that they're going to get paid back, and charge you an interest rate accordingly. But that's a very straightforward, very simple type of borrowing. The second type of borrowing, which is a little stronger from an investor's perspective, is called an alternate revenue bond. And for that, you promise that if you ever can't come up with the money to make your debt service payment, then you will have the authority to levy a backup tax, and actually an additional property tax to pay for the debt service. And investors like that because it's an additional security. Debt certificates, you can only go out for 20 years. alternate revenue bond, you could go out for 40 years, although most likely, practically speaking, you would only go at most 20 years. And that one requires a little more work to authorize. You have to go through a notice and petition period and things like that. So sometimes people like the simplicity of debt certificates. Other times they like the better interest rate that they typically get from an alternate revenue bond. But you do have those two choices. You can also do a mortgage. I have seen that here and there, but there's not too many reasons for you to do a mortgage when you have these other options. Mortgages were in place before these other two options were authorized by the law with the Debt Reform Act. And then, like I say, you can always go vote. So if you wanted to borrow, if you had a project, you wanted to do it, very important to decide, can I afford it? And so let's say you went through your projection, right? I would not want you to go out and borrow without doing a projection. You look in your budget, and let's say you decided you could afford somewhere between $70,000 and $161,000 for debt service annually for your project, and you had a $6 million project. Well, you'd look in your reserves. How much surplus do we have? We set aside, let's say, $1 million. And then above and beyond that, because our cash balances in our general fund sound pretty good. Let's say you came up with another 540 to 890,000. That debt service number that we budgeted, 70,000 to 161,000, supports maybe $1 million to $2.4 million of borrowing, which leaves us with a shortfall of 1.7 to $3 million in this particular example. So, then you scratch your head and you say, well, what do we do? Do we downsize the project? Do we look at our budget and try and find more room in our budget? What do we do? But if you don't do this analysis, if you don't do the forecast, you might forge ahead with your $6 million project only to find out down the road that, gee, now we're in total financial straits. We have to cut hours, reduce staff, things like that. And you just don't want to be there as a result of having gone ahead with a project that was too big. So I think this kind of forecasting and planning is very important if you're looking at a project before you engage in it. If you're going to go ahead and borrow, it takes about 69 to 90 days once you decide to go ahead with the project. You got to figure out what type of borrowing you're going to do. And that's after you've done the financing plan. What kind of borrowing are you going to do? How do I want to sell the bonds? All different ways. You have to document it, get your financing team in order. You have to go out and get a bond rating. And then you'll price the bonds and you'll close the bonds. That kind of overview of the process takes about, like I say, 60 to 90 days. Okay. Another thing that you as trustees are going to be seeing is some increase in personnel costs as a result of the minimum wage. And you're probably familiar with this at this point, that the minimum wage is going up to $15 by 2025. Easy way to remember what the minimum wages in any given year is: the last digit of the year matches the minimum wage. So 22, it's 12, 23, it's 13, 24, it's 14. But this, this is creating havoc for you, because your ability to increase revenue may or may not keep up with, your property taxes may or may not keep up with wages. So it's budget stress for you. We're going to talk about pay fairness across positions, maintaining pay competitiveness. If you're bringing people just up to that minimum and other people are competing for employees above that minimum, creates a problem. And this hits the smallest libraries the worst. Unfortunately, there's no way around it. And like I say, it hits you harder because you can't raise your revenues just because your costs are going up. So a couple of strategies to think about as you're addressing this minimum wage issue. One is, for everybody who's below the minimum wage, we're just going to bring them up to the minimum wage. The problem there is anybody who made just a little more than the minimum wage and felt like they were being rewarded for having some additional skill relative to people who are making the very least among your staff are now going to be making the exact same amount. And they're going to feel like they are not being rewarded for their additional expertise. So you could look at, what do I do instead? Well, I could give everybody the same percentage of increase, but everybody moving up is going to be tremendously expensive. You could also do same dollar increase for all. Same thing. Everybody's getting that increase, still very expensive. So I think the most appropriate way to do this is to create sort of a band. There are people down at the bottom for you who will come up to the minimum wage. And there are people who, at some level of pay, it makes no difference that people below them are getting not excessive, but extra increases, because they make, they're on a different pay tier altogether. So those people you can disregard and just treat them as you ordinarily would. But for this little range in between here, where people felt that they had some expertise that kept them above the minimum wage, maybe you'll give them a little extra boost to keep a spread there. And you have to decide how to do that. But for the best way that I've come up with to do that is just for some range of people, you're going to give them some extra increase to keep them above the minimum wage as you bring everybody else up. We talk about that as wage compression. It still compresses a little, but you're still rewarding people for the extra expertise that they have. And when you do that, you're going to see what your overall payroll costs are. And then you may have some decisions depending on your budget. Do you have to eliminate individual jobs? Does this reorganization of pay, is it better to eliminate whole positions, or do we calibrate pay grades as we go along? So there's a lot of work to be done there and strategizing. But if you come up with a strategy for dealing with it, at least then you'll have a framework for working on those adjustments. Okay. I'm not going to get through my whole presentation, but we'll get as far as we can. This is very important here to understand. Everyone should be on the same page with vocabulary. And I find that there's a lot of confusion over terminology when it comes to money and funds and things like that. So let's make sure that when you're having conversations, you're using terminology that is consistent and understandable. So we talk about funds. When we talk about funds, people use funds in different ways, but you should be talking about funds as the statutory allocation and reporting funds. So we have the general fund. We're not talking about money, we're talking about the general fund, which is a reporting group, and the IMRF fund and the Social Security fund, okay? And those are funds that have specific purposes, and money is restricted in those funds is restricted to specific purposes. But then you have your cash, and you keep your cash in bank accounts. And those bank accounts are not funds. Cash isn't funds, so don't refer to cash as funds the way we sometimes do. And don't refer to your bank accounts as funds. They're bank accounts. Now, it's possible those bank accounts are set up to hold only money for specific funds, right? But those bank accounts are not the funds. Those bank accounts are bank accounts, all right? So keep the funds and the bank accounts distinct in your mind, because sometimes your big bank account might hold money that really belongs to the IMRF fund and to the Social Security fund and to your general fund, and that money's all mixed together. So you can't look at that account and say that's a fund. You have to keep those two things separate in your mind. And then we talk about bank accounts, and we talk about your chart of accounts. Your chart of accounts is, hopefully you're getting monthly reporting, right? And you're going to see exactly how your expenditures are organized, and that's your chart of accounts, and you can watch that. But once again, there's not specific bank accounts set up for those individual ledger groupings. Okay, so hopefully keep straight when you're talking about bank accounts versus statutory funds, which you're talking about, so that that'll make your discussion much clearer. Now, typical funds that you'll have, as I said, general fund, you may set up a fund for debt service money, working cash, a special reserve that we talked about earlier, and you might have an endowment fund, again, separated out. In addition, we have all these other kinds of funds that you might set up, an audit fund, because if you have a levy for audit, that money is going to be restricted to using for the audit. IMRF often, Social Security as well. And when you set up a fund and money is raised specifically for that fund, the money, no matter what bank account it is, has to stay allocated to that fund, and you can't spend it on any other purpose. So the more money, this alludes to the question that we had before, the more money you can keep in your general fund where it's not restricted, the better off you are, because if you accumulate too much money in your Social Security fund, right, you're not going to be able to spend it on anything else. It's just going to have to sit there and accumulate, and then you might get subject to tax protests, the way we were talking about before. But these are, generally speaking, the types of funds that you're going to have. General fund is where you put most of your money, and it gives you the most flexibility for spending that money. So the more money you can keep in general fund, the better off you are. Working cash fund, just some people have it, some people don't, as a general cash reserve for times when cash runs low. And if you can fund a working cash fund, that's great. There's limitations on how much you can put in there as well. Here's a chart of accounts. Hopefully you'll recognize this and you get it monthly. You'll get a listing of your general ledger as, you know, tracking the budget. What did you spend? How much have you spent year to date on all of these different areas? And this is what you track against the budget, right? This should tie back to the budget. Are we overspending the budget? Are we underspending the budget? Where are we good? Where are we challenged? Okay, so you should hopefully get a monthly report of all your revenues and expenditures that looks, you know, something like this, broken out by use of funds. All right. Last thing, and I think this is probably as far as we're going to get. We're not going to be able to delve into the levy too deeply, but I want to at least cover this at a high level. Again, terminology, very, very important here. All right. There's your levy every year. The levy is what you submit as a request for property taxes for the coming years, either to the county directly or to the municipality to pass along to the county. The county then takes that levy and they do a bunch of calculations and they figure out what is going to actually go onto the tax bills. That's the extension, okay? Very important that you distinguish between, when you're having your discussions, when you're talking, that you distinguish between the levy, which is what you ask for, and the extension, which is what actually gets put on the property tax bill. Then, once those tax bills go out, once those tax bills go out, you're going to make collections. And you might not collect everything because some people might not pay their tax bills, right? So when you're doing your budgeting, you can't look at your levy. You can't look at your extension. You have to plan your real budget. You have to plan on what you're actually going to collect. In some places, it's 100%. Everybody pays. More challenged communities, it might be 95% or 90% or lower. And if you're budgeting for your levy or you're budgeting for your extension, you're going to come up short when you match against expenditures, because you're not going to have all the money that you anticipated. So levy, extension, and collection is very important. I'm going to skip a little here. Let's get to the most important things here with how, Cindy, do I go to 9:50 or do I go to 10?
I think we can give you an extra 5 minutes to go to 10. If anybody needs to step away, that's fine, but we'll take a 5-minute break instead of a 10-minute break. How's
Sure.
that?
That's great. And I'll stick around during that 5-minute breaks in case there's questions.
Great.
Around.
Thanks.
If you're tax capped, I just want to tell you, so the limitations, okay, on your levy from one year to the next, okay. Simple way to calculate what's going to happen to your levy if you're tax capped, okay. Look at last year's extension, okay, so not the levy, not the collections, but the actual extension, last year's extension. You can increase that by inflation, and next year it's 1.4%, plus whatever percent you think your tax base is going to grow due to new business. And in most communities, that might be 1%, 2%, something like that. That's what you can expect your extension to grow by each year. And it's really that simple. You just think, okay, I'm going to get inflation next year, and I'm going to get some amount of new property, and historical new property, you know where to look that up, can inform that. And whatever that percentage is, you know what? That's what you can expect, and that's what you can budget for an increase in your extension. Then, of course, you have to apply the collections. So people get tied up in the levy and how it's calculated and what to do, but it's really, if you're tax capped, pretty straightforward. If you're not tax capped, you're going to have specific fund limitations that you can't go over. And so if your tax base grows by 4%, you can increase your levy. The extension can go up by 4% as long as you don't hit, specific fund maximums. And we could spend another hour on this, and I'm sorry we didn't get as far as I wanted to here, but if you're tax capped, you're going up by inflation plus new property. If you're not tax capped, you can go up as fast as your tax base goes up, as long as you don't exceed individual fund maximum rates. So in a lot of cases, if you're not capped, it's 15 cents. I've got 60 here. That's a different subject. I thought I had it in here. And so for that, you have to keep your eye on your tax base and see how that's going up. So I'm gonna stop here, because to get into anything else would take us a lot more than 2 minutes. And ask any questions that you have, please.
We have a question. Our public library district budget includes a revenue line item for the typical levy, but also includes book and e-media advance and equipment advance. These two in the same amount show up on expenditures as well. Do you know how these can be used? Why would these show up as an in and out? I'm told it's common practice for this to be in the budget.
Sure. So just so I'm clear, can you read the very first part of that question again?
Sure. Our public library district budget includes a revenue line item for the typical levy, but also includes a book and media advance and equipment advance.
Okay, so you said budget, right? So when you're budgeting, right, you're identifying all the different types of revenue. Now, I don't know specifically that line item, what revenue that would be, but presumably it ties to a grant or some source of revenue that you've identified that's coming in regularly. So I would expect in your budget that you would see property taxes, personal property replacement taxes, your per capita grant, donations, things like that, and every source of revenue that would be outlined in the budget. I hope I'm answering the right question here. And then on the expense side, right, you would see those individual expense lines as well, your personnel, your operations, your maintenance. And sometimes a grant comes in as revenue, and then you're expected to spend that exact same amount on the grant. So you'll see that as an expense line as well. And so often those two things will be identified in the same way, because it's grant for a specific purpose, expenditure for a specific purpose, and you would want to identify both of those because they're both part of the budget. I don't know if that answers the question. I think that's what you're asking.
There is a follow-up comment. These are listed as library tax levy, so it appears to be related to taxes.
Okay, so so in that situation, again, can't give you legal advice. In that situation, it sounds like you're breaking out the purpose of your property tax levy to specific sub-purposes. And I'm guessing that's a fine way to do it. I haven't seen it done that way. You know, mostly people property taxes and that's it as their revenue, but maybe you're breaking out the property, the purposes for which you're levying a property tax. And that's probably okay. I don't see a problem with that. But you might not have to do it.
Our next question is, what do you do when you don't receive enough in your special funds?
Okay, so this is actually a pretty easy one. So let's say you under levy in your special funds for IMRF. You can make that difference up from your general fund, right? So your general fund has no restrictions on, well, with respect to this, no restrictions on what you can spend money for. So you can spend general fund money on IMRF. So if you levied $30,000 for IMRF, but then had $50,000 worth of IMRF expenditures, you could do one of two things. You could either transfer money to the IMRF fund and then spend it, but there's no real reason to do that. You'd simply make up the difference with an expenditure from your general fund.
If there are any other questions, please go ahead and put it in the Q&A or in the chat. I will give a plug for a presentation that Jamie will be doing in October at the ILA annual conference, Master the Property Tax Levy. So he's going to really dig in deeply for the information on the levy, and registration for the conference will open up this summer.
Terrific. And well, and let me thank everybody. Please, there's a lot of information that we didn't get to here, specifically on the levy. And so read through there, because I think you'll get a little bit more than we were able to get to. And sometimes the levy is the most confusing thing for people. So if you have questions, obviously reach out and ask me. I'd be happy to address anything that you have. All right. So thank you, everybody.
Right.
Appreciate
Thank you, Jamie. And we will take a break. I have 9:58, so we will come back at 10:05.